At 9:30 in the morning, the market opens. Millions of people watch their screens. Some buy, some sell. Most just watch. It feels chaotic, random, emotional. But here's the uncomfortable truth. By the time you see a price move, the decision that caused it was already made somewhere else. Because the market isn't controlled by the loudest voices. It's controlled by the fastest reactions to invisible forces most people never see. And the strangest part is, there isn't one controller. There's a system. And it quietly decides what everything is worth. Most people imagine the market like a giant voting machine. More buyers than sellers, price goes up. More sellers than buyers, price goes down. Simple. Fair. Democratic. But that's not how it actually works. Because not all buyers are equal, and not all sellers are reacting to the same information. Imagine two people. One is sitting at home checking prices on their phone. The other is sitting inside a massive financial institution connected directly to the core of the system. The first person reacts to the news. The second person reacts to the reaction. And that difference changes everything. Now let's zoom out. Every price you see in the market is just the result of the last trade. Not the true value, not some objective number, just the last agreement between two parties. If someone buys a stock at $100, the price is now $100. Even if millions of people secretly believe it's worth less, or more. The price is not a truth. It's an event. And events can be influenced. Now, here's where it gets interesting. Most of the money in the market doesn't belong to individuals. It belongs to institutions. Pension funds, insurance companies, mutual funds, sovereign wealth funds. Together, they control tens of trillions of dollars. Not millions, not billions, trillions. And they don't trade like individuals. They move slowly, carefully, strategically. Because when you control that much money, even a small decision moves the market itself. If a pension fund decides to allocate just 1% more into stocks, that can mean billions of dollars flowing in. Prices rise. Not because the world suddenly became better, but because money needed somewhere to go. The flow itself becomes the signal. But even these massive institutions aren't fully in control, because they're reacting too, to interest rates. Interest rates are like gravity for money. When rates are low, money spreads outward, into stocks, real estate, risk. When rates rise, money pulls inward, towards safety. And interest rates are set by central banks, which means a small group of policymakers can influence the direction of trillions of dollars with a single decision. Not by commanding anyone directly, but by changing the environment everyone else operates in. Like adjusting the slope of a hill and watching where water flows. And then there's liquidity. Liquidity is the ability to buy or sell without dramatically moving the price. When liquidity is high, markets feel stable, calm, predictable. When liquidity disappears, even small trades can cause massive swings. This is why markets sometimes crash without warning. Not because everyone suddenly panicked at once, but because the system lost its ability to absorb movement. It's like walking on solid ground that suddenly turns into ice. Same steps, different outcome. Now add one more layer. Algorithms. Today, a huge percentage of market trades are executed automatically, not by humans, by machines reacting to patterns, signals, and probabilities. They don't feel fear. They don't feel confidence. They react instantly. If conditions change, they adjust in milliseconds. This makes the market faster, more efficient, and sometimes more fragile. Because when machines all react to the same signal at once, movements amplify. Not gradually, but all at once. So when people ask who controls the market, they imagine a person, a mastermind, a hidden hand. But the truth is more unsettling.
The market is controlled by incentives, by liquidity, by interest rates, by institutional flows, by algorithms, and by human psychology reacting to all of it. No single entity is in charge, but the structure itself shapes every outcome, like a maze that quietly guides everyone inside it. Even the largest players are still responding to forces bigger than themselves. This is why markets can rise when the economy feels weak and fall when everything seems fine. Because markets don't measure the present. They measure expectations, flows, and constraints. Not reality, but the system's interpretation of reality. And this creates a strange paradox. The market feels like a place where individuals make decisions freely. But most of those decisions are shaped by conditions individuals didn't create. Interest rates, liquidity, institutional mandates, risk models, all invisible, all powerful, all quietly influencing what happens next. So the next time you see the market move sharply, ask yourself a different question. Not who bought or who sold, but what changed in the system that made that move inevitable? Because the most powerful force in the market isn't a person. It's the structure itself. And once you see the structure, you start to realize something even more unsettling. If the system is what controls the market, then who controls the system?